Want to start building wealth? Think about making sure that you've got these 5 essential accounts opened. These are the right accounts that you need to step up and climb that financial ladder. With these accounts, it really doesn't matter if you're just starting out or you plan on leveling up. Number one, you need a solid checking account. This is essentially the basic account that you need to receive any income that you probably are getting from a job you're being paid, a side hustle that you're working on. If it's a business checking account, it's going to be an account on which you're receiving money into that account. And with this account, you get to pay your bills from that account, you get statements from that account. And the most important thing that you want to avoid once you have a checking account is making sure that you are not paying any unnecessary monthly fees or avoiding overdraft fees. The second account that you will need is a high yield savings account. This is your financial cushion. This is your emergency lifeline. You want to make sure that you have at least 6 to 12 months of emergency funds in this account. This account typically has very high interest rates. The bank will usually pay you interest rates between 2.5% to 4%. It just depends on the bank in which you are in. Just so you know, having said that you need a high yield savings account doesn't mean that I'm discounting other savings accounts. I'm simply looking at ways that you can have an account that has your emergency funds that helps you grow your money. And in any case, with these accounts, you need to have a certain amount of money to be in this account. With high yield savings accounts, a lot of banks will require that you have a specific amount of money in this account. If you want to know more about high yield savings accounts, click on this video to get an in-depth look at what they do. Oh, and by the way, make sure that your high yield savings accounts and your checking accounts are FDIC insured. Once you have these two accounts in place, you start thinking about retirement. Are you going to be going with a 401k, a traditional IRA, or a Roth IRA? Today, I'm just going to be talking about a traditional IRA or a Roth IRA. A lot of companies will offer a combination of these retirement accounts, be it a 401k, Roth IRA, or traditional IRA, or they will offer just one option. It depends on the company and their abilities to secure these financial benefits for their employees. With traditional IRA or 401ks, you contribute pre-tax dollars that are then being used to invest into your account. However, with a Roth IRA, you contribute after-tax dollars. This grows over the lifetime of this money being invested in that account. And at 59 and a half, if you intend to withdraw the money at that time, all that money collected from that account is tax-free and you don't get penalized by the authorities. A traditional IRA or a 401k gives you a tax break. Today, you get to pay taxes at a future date, ideally at 59 and a half, when you don't have any idea what the taxes will be like. Next is your brokerage accounts. With brokerage accounts, there are no contribution limits, unlike IRA, 401k, or the traditional IRAs. Also note that there are no early withdrawal penalties. In brokerage accounts, you can invest in stocks, index funds, or ETFs, you name it. There is a lot of flexibility that comes with brokerage accounts. And finally, credit cards. Yes, when you use them responsibly. Why credit cards? Because they help you build your credit. There are lots of rewards that come with some specific credit cards, and there are a lot of purchase protections that come with using credit cards to purchase everyday goods. How do you use credit cards responsibly? Make sure you pay your balance in full before the end of the month. That's the key. You purchase something, pay as soon as you can. Once you do that, you don't have a balance that generates interest for a credit card company. And that's how they make their money. They essentially hope that you will pay the minimum balance on any cards that you have. And once you pay the minimum balance, that's fine. That's the minimum balance just for that month. But then anything that you have after this minimum payment, that becomes interest for them. Credit cards typically have very high interest rates of at least 20%. Here's a quick tip. Start with credit cards that have no annual fees on them. Hopefully, they provide you some cash back. Once you start growing your credit, explore cards that have travel rewards and other benefits. Thanks for watching. Like, subscribe, comment, and let me know which fintech tools you use to manage your money. Thank you.